I'm here with Jimmy Allen. I'm going to be turning out a little bit this music down. I'm here with Jimmy Allen. It is a pleasure to have you here, Jimmy.
Thank you, Maly.
We get a lot of questions for people that are wanting to buy a home here in Hawaii and they don't know how to do it. So, brought you guys the expert on lending. Jimmy, you've been doing this for how many years?
Over 30 years now.
Oh, just 30
Just 30 years.
Just 30 years.
30 years.
And he is the expert.
Followed in my mom and dad's footsteps in real estate.
So Jimmy is going to be sharing with you guys his background, but primarily, if you haven't already, because we're going to be posting this interview in Facebook and on YouTube also, but for YouTube people that are watching, go ahead and follow us on Facebook. The name of the Facebook group is I'm Moving to the Big Island of Hawaii. Feel free to join. It's free. And hey, we got a couple of hearts, likes. Aloha, guys. Aloha. And so thank you so much for being here and for watching this beautiful interview. So Jimmy, take it away. Share all of your knowledge to the people and your background. What do you do? Who do you work with? And just a little bit about yourself.
Happy Aloha Friday, everybody. My name is Jimmy Allen. I'm with Guaranteed Rate. I've been in the mortgage business for over 30 years. I started, I'm not going to say what year, but it's a long time ago. I started as a real estate appraiser. I was doing appraisals in Santa Cruz County, trying to go to college. And both my parents were in real estate. My mom's was a broker here. They bought Koa Realty, Kahamoka Realty. And when I was in college, what does a parent that's in real estate say to their son? Why don't you look at going into real estate? And ended up getting a job and selling real estate in Ben Lomond, Boulder Creek, and Felton in Santa Cruz, California. Ended up coming back to Hawaii and working for Bank of Hawaii. Wow. As an appraiser and drove around the island appraising properties, and then ended up getting into lending. Which the best thing I did was stopping to being an appraiser and became a lender. But it's been a very rewarding career, and been doing it for so long that it's second nature. But I'm here to spread some of my knowledge about the real estate business and real estate lending.
We are very lucky to have Jimmy here. And I'm so sorry, you guys, I'm looking down because I'm just sharing this interview with the other pages that we have up. But we are so blessed and happy that Jimmy is here with us answering all of the questions that we get almost on a daily basis on how to get finance here in Hawaii. And thank you for sharing your beautiful resume. Because, it starts at home. Like Jimmy has like this solid foundation that not a whole lot of local lenders have. The fact that, your family was in real estate and development and lending and all that. And he brings in like the whole spectrum, right? You got it all, Jimmy.
Yeah.
So, he's very, very smart. I refer a lot of my clients your way and they're very happy and we're getting a lot of hearts and thumbs up. And so Thank you so much, guys. So without further ado, we're going to go right into the lending questions. Woo-hoo! So what type of loans do you have available, Jimmy?
We have all types of loans, from first-time home buyers to jumbo financing or non-conforming loans, high-end loans. But like I said, the ones that I like to do are first-time home buyers.
Yeah.
Because they're a little bit more rewarding to get somebody into their first home. But the programs that we have, we do conventional loans, which is your standard 30-year fixed. And then we have non-conforming loans, which is your jumbo loan. And in Hawaii, a jumbo loan is loan amounts above $822,000, and a conforming loan is below $822,000. Mm-hmm. And we have FHA loans, VA loans, USDA loans. Both FHA requires 3.5% down. VA is 100% financing if you're a veteran. Mm-hmm. And USDA will also do 100% financing in limited areas. It has to be a more rural area like Hilo, the proper area, the city of Hilo, or the county of Hilo. It's not a city, but the area of Hilo is considered to be an area that you can't do a USDA loan in. But Kailua Kona, you can. Mm-hmm. And it's based on the total population of those districts or those areas.
That's great that you say that, because sometimes people, they're approved for USDA and they think that they approve for the entire island. And sometimes
it is most of the island.
It is most.
But again, it's surprising that in Hilo it's not available
right.
when you're in the city or the area of Hilo. That's not a
Right.
city, but
Yeah.
but if you go outside of Hilo, it is available in pretty much anywhere else on the island. And the thing about a USDA, it is 100% financing, but there's income restrictions with the USDA loan,
Yes.
and because they're doing 100% financing, the debt to income ratios, which is how much income you have versus how much debt you have, are lower, and it makes it a little bit harder to qualify for a home, using the USDA.
Yep. Oh, thank you guys. So now, what are the most popular loans?
Well, the most popular loan is a 30-year fix because it's set and it's consistent and your payments never change. Is that the best loan? It's going to depend on your situation. A 30-year fixed rate, if you're not going to leave, you're going to live there forever. You buy your primary residence and you're not going to sell. You're going to stay there. It's probably the better loan for you. But if you're buying a first-time home and you're going to stay there for 5, 7, 10 years, there are ARMs, or adjustable rate mortgages, that are fixed for 5, 7, or 10-year periods. They don't change. They don't adjust during those periods. And it doesn't make sense to pay more for a 30-year fixed if you're not going to stay there longer. But there's a lot of people are afraid of the ARMs, and there's a bad connotation around the ARMs because there were a lot of ARMs that were bad, and they really are no longer in the marketplace. So most of the ARMs are going to be, like I said, fixed for 5 years, nothing changes, and then it'll adjust after the 5th year, or you can have it for a longer period, 7 or 10 years.
And then when you get into an ARM situation, you can also refinance, right?
You can supposedly always refinance.
Yeah.
It's never a guarantee to refinance because the market changes. One of the problems that we had when the market was very difficult for people is that the values of properties went down so much and they had ARMs that were adjusting and they couldn't refinance and they couldn't sell. So, and it was never good to say that you can always refinance because it just depends on the market. But you want to be able to, if you do an ARM, you want to be able to know that you're going to be able to make that payment after it starts to adjust. And the other thing about an ARM is that as time goes by, hopefully, and most of the times, your income is going to be increasing as well. So if the payments do adjust, you'd be able to afford that. But if the goal is to sell within 5, 7, or 10 years, then you would go ahead and do that. If you're nervous about that, then obviously the 30-year fixed rate is going to be better.
And you know what? And that's where we can come in to assess. Sometimes people want to look for a property and stay there for the next, 3 years or so. And so, if you didn't have anybody that could fully explain, what will be your best options.
And each situation is going to be different for each individual.
Exactly.
And it's hard to make a blanket statement. I think a lot of people go, I do nothing but a 30-year fixed rate. Well, that ends up could be worse for you because if rates go lower, if you're in an ARM, your rates can also adjust down. They don't always adjust up.
Yeah.
And, right now we're in a very low interest rate environment.
Yeah.
And there's not that much that much of a difference in ARMs versus a fixed rates right now. So it would be pretty good to probably have an ARM. Right?
Okay. Derek, he's asking, I don't know if you guys can see it on the screen. Is there a cap for the interest rate adjustment?
Yes. Most ARMs, it's a variety of different products, but majority of them are fixed for 5 years, as I said. And then there's a cap of how much you can go up annually and for the life of the loan. And it varies from 2% to for annually, 2% yearly and up to 5-6% for the life of the loan. So if you had an adjustable rate mortgage at 2 3/8, and it's a 5-year, over a 5-year period, the maximum that could go up to would be 7 3/8. But it wouldn't adjust until after the 5th year. And then in the 5th year, it can only go up 2% or whatever that cap was for the annual. And then over the life of the loan would be the 5% cap.
5% cap. Okay. Thank you so much for answering that question. Now moving on, what are the benefits of working with a local lender?
I think the main benefit is just the knowledge of the real estate market.
Yeah.
And I kind of think of it, if I could do loans all over the country, I don't do it because, I don't want to go into a place I'm not familiar with and come across something that's going to cause problems. In Hawaii, one of the things is with condominiums, and in Hawaii, condos are not a condo or not a condo because there are changes. And condos here, a lot of them are run like hotels where you can check in.
Condos, yeah.
Condotels. And so a mainland lender may not realize that that's a condo they think they can do, and then at the end of the deal they can't because they can't get it approved to be sold to the secondary market, which is Fannie Mae and Freddie Mac, and most loans are sold to the secondary market, and that's a reason to have a local lender that's going to have that knowledge.
Yeah. And you know what? And I do have this conversation very, very frequently. People that are asking, they have their friend who's a mortgage broker on the mainland for years, and they've done several transactions with this person, and it's kind of hard for them to like move away from their mortgage broker. But this is where we need a local lender. And especially for condominiums, like.
Well, and I like to think it too as being a local lender. If the agent, your referral source, or if you are sending me a client and I don't do well, I mean, you can always go knock on my door at my office and visit me in person. I can find them. Whereas if a mainland lender, you're talking on a phone, you're going to get transferred all over, and who knows when you ever actually get in front of the person that's doing your loan. Right. But and obviously I want to do a good job for Maly and for the local real estate agents. So I'm going to work hard to do that.
Yes. And you know what? And he's, and not because you're here, but he's very responsive. He really takes care of the people that I work with. And, you got a lot of hearts right now. You really take pride of your job. And, but yeah, it is just great to have somebody local that understands, what are the requirements, what are the down payments, and let's talk about the down payments on condos. That is like, there's
the variety. Well, we can talk about down payments in general.
Yeah.
So down payments on a conventional loan, like I said earlier, you can have some that are 100% financing, which is the VA, USDA. And FHA is 3.5% as a down payment, but the FHA has loan limits, and in Hawaii, the limits are set by the whole county. So you're taking the west side and the east side together, and so that loan limit is a little lower. And then conventional loans you can do with 5% down. Anything under 20% down on a conventional loan requires mortgage insurance. The VA doesn't have mortgage insurance, and that's one of the benefits of the VA loan.
VAs,
FHA will have mortgage insurance, and USDA has mortgage insurance as well. It's a little bit less than your conventional and FHA. And mortgage insurance is basically when you're not putting a 20% down payment, you're ensuring that the mortgage insurance is to insure the lender for that equity position that they're not going to have because you don't have the down payment. And if you think about it, if you put 5% down and you miss a few payments, that's going to pretty much take care of your equity rather quickly. And that's what that mortgage insurance would come in. So it's if bad things happen. But the mortgage insurance is good because if you're trying to save for that down payment, and as real estate continues to rise, you're kind of running in place because the more you save and the longer it takes to save as prices increase, you'll have a harder time to get in. And there is different opinions. Some people say you should never buy a house with 20% down. If that was the case, I would never ever bought my first home.
Right.
So the low down payments is a good thing.
Yeah. That's great advice on the down payments. So now, how can people qualify for a loan? Call Jimmy?
Call me, yeah. Well, the best thing to do to qualify is to do an application with a lender that you trust and start the pre-approval process before you go out and look at real estate. Because the last thing you want to do is you go out and find your dream home, and then you go in, okay, I want to qualify, and then you don't qualify. And now you go back and you qualify for, you're looking at 500,000, 600,000, 700,000, and now you only qualify 300,000, 400,000. It's really going to be harder to find something that you like because all the ones that you like cost more. So best thing to do is to get pre-approved, and the pre-approval process is fairly easy. Everybody has online applications. I have an online application that you can go to, and we will pull credit. We'll run your credit to determine where your credit scores are, and then we'll verify what your income and what your assets are. And it runs through an automated underwriting system, and it provides a decision. And that decision, as long as we can verify the information that you provided, your income, your assets, and then pretty much it's, we should be able to do that loan.
Okay. Now okay, so that answers that. Do you have to be employed in Hawaii to qualify?
No, you don't have to be employed in Hawaii. But if you are employed in California, you have to be able to work in Hawaii, being employed in California. And the thing that has changed, obviously, with COVID is that more and more people are working remotely.
Yes.
And it's becoming more and more acceptable to work remotely. Before, when we would do this, it was harder. It was harder to explain to people that I'm working from home. I'm living in Hawaii, but I work in California.
Yeah.
And most of the time they would think, well, if you live in California and you work in California, you can't be in Hawaii and qualify. That's no longer true. So you can live anywhere, really, as long as you have the ability to work remotely and your employment or your employer will let you work remotely. The hard part, if you're self-employed and you move to Hawaii, even though you had all your clients and your business in California and you're doing the same thing in Hawaii, it's a little bit harder because we have no way of knowing that you'll be able to do the same volume of business moving here and setting up new clientele and having a new business. So that's a little bit harder when you're trying to buy a home and you're self-employed and you're moving to Hawaii, plus you're moving your business to Hawaii.
You know what? I think that people that struggle the most, people that are self-employed, that have, say, for example, electricians, right, that have to transfer their whole license over to Hawaii and wait for that time period to pass. I think those are like the ones that have like a little bit of the harder time. But yeah, to your point.
But to start qualifying, the best thing is to sit down, and I do this all the time, and consult and determine what your situation is. You do have to have a job.
Yes, please.
And you need to keep that job through closing, because at closing, before we close, we do verify that you're still employed.
Yes.
And then you want to have your down payment saved if you're doing anything with a down payment. And you want to have that money seasoned in a bank, because you have it in.
Explain season.
So you can't, we like to call mattress money.
Mattress money.
So there's no way for us, and we have to verify where your down payment comes from.
Yeah.
Whether it's borrowed, gifted, and it can be gifted. Borrowed, it has to be borrowed against other real estate. But if you have it in your mattress, there's no way for us to verify it. But if you get it into a bank and it's seasoned in the bank for a couple of months and we can verify that, then we can use it. So all those people that have mattress money, not good if you want to buy a house. Or if you want to buy a house. And other thing, if you're self-employed, you want to report your income, because we're going to only qualify you on the income that you report to the IRS. And it's just unfortunate that's the way it is. A lot of people come in and I'll look at their tax return and they say, I make more money than that. Well, no, you don't, because if you don't have it reported, we can't use it.
Wow. Or people that have like really high car payments, right? That's one that we have come across.
Car payments. Student loans. Yeah, those are things. Any type of debt that you have is going to make you qualify for less. So ideally, it's to have little debt. Don't buy a brand new car. Buy the house first, then buy the car.
Great advice, guys.
Because the car payment will keep you from qualifying.
Yep.
Once you have the house, they'll lend you the money for the car.
Right.
You know, getting a home loan is going to be a little bit different, and we have to factor in that, crazy $800 a month payment. That $800 a month payment can qualify you for about $150,000
you're gonna look good in that Tundra, but no home.
No, I'd much rather have the guy pull up in the old Juki than the brand new Lexus.
So that's great. Like get a home first and then the car, if you can, right? But that's great advice. Let's see. Well, in escrow, what are the big no-nos that people should not do while we are in escrow?
Go buy furniture, buy a new car, incur any type of debt. You really don't want to do that while you're in escrow.
Yeah.
Change jobs, lose your job. Lose your job and then don't tell anybody about it. If you lose your job, that can happen. But when we approve you for the loan, we're going to approve it based on the job and the income that you have and the assets that you have. And if we get to the end and that's changed, your financial situation has changed, and we may no longer be able to make you that loan.
Yeah.
So it's important to keep things the same as you go through escrow.
Yeah.
And if you do change jobs, we see that can work, but you need to let us know that that's happened, so we can make sure that we can plan for it.
Yeah.
and accommodate it. And hopefully if you're changing jobs for more income.
Yeah. Yeah, that's exactly, because if you do have that change of a job and it drops significantly to where you were making before, it just can we cannot work
Yeah.
a magic wand and make that disappear, right? So that's very important. What happens? What is the minimum credit score required?
It varies by loan. So a conventional loan is, and there are some variations of this, but most of the industry is 620 as a loan. So it's not that you have to have perfect credit to get a house, to get a loan. FHA and VA and USDA will go to a little bit lower of credit scores. But 600 is probably the minimum score.
600.
Yeah, and your credit score is going to affect the rate that you get, and it will affect qualifying as well.
Okay.
So pay your bills on time.
Yes.
That's one of the things that you need to try to do. And and everybody has challenges in life. But if you do, it doesn't mean that you can't get a loan, but it will affect your ability to qualify. And the goal is to try to get to where you have a decent credit score, because it's going to be so important, because that's what the rate is going to be based off of.
Right. And then if you do have a delinquency or a problem, just try to, work it out with the institution, send out the letters, or what other thing people do to fix that.
You can, a lot of people do this, and it's easy you can ignore it. So you have something you don't pay, and you just let it go.
Yeah.
And then, that'll come back in 3-4 years when you go ahead, and it's still going to be there.
Yeah.
They're still going to be trying to collect the money that you owe.
Yeah.
And that's not a good thing for applying for a house.
No.
And we look at your credit, and they look at things that are 30 days late, 60 days late, 90 days late. If you have 90-day late, 60-day late, and you have multiple of those, it's going to be really hard to get a loan.
Yeah.
And if you have a house and you miss a mortgage payment recently when you apply, that'll almost always keep you from buying that second house or that investment property. So maintaining a good credit is really good. And I know it's easier said than done. Like, everybody just pay your bills on time. But life happens,
Life happens, but, at least you have to get out of it and just try to resolve it, at least, if you want to make things happen.
And so there are things when there are people that have had to file bankruptcy or been foreclosed on or have done short sales. That doesn't mean that you'll never be able to buy a house again.
Yeah.
It just means it'll have to have some time. You have to reestablish credit. And it varies based on the reason that you had the foreclosure or you had the bankruptcy. Now, if you had medical issues and something happened, you lose your job because of that, that's going to be something they're going to look at, and the time to wait is going to be less. Now, if you just bought all these things and, now you can't pay it, and it's just there was no, what we call financial mismanagement, and you do a bankruptcy or a foreclosure, it'll be 7 years versus 3 years.
Yeah.
And that varies also on certain loan products. And FHA is a little bit more lenient on that waiting period, but those in general that you would need to wait and get your credit established again.
That's a lot.
and then and the thing is that when you're working on, getting your credit scores, if you had some struggles and you're starting to work and you're starting to get the scores back up, what you don't want to do is miss a payment. Because once you miss, when you have challenges with credit and then you miss a payment, it's going to really just kind of pummel your scores.
Exactly.
Because you're already struggling. And that's the way they look at it too. The other thing with credit scores, if you have 3 accounts and you pay 2 of those bad, I mean, that's, 70%, 66% of your accounts that you don't pay as agreed. So it does benefit you to have more accounts and pay those accounts on time. But if you have, 15 trade lines and you miss 1 payment, that's not going to be as bad. But again, if you have 2 or 3 and you have late payments, that'll make it really difficult on the scores.
And I think, and to your point, a lot of the people that are looking to buy a home, whenever they get together with Jimmy, right? Oh, I'll just say with him. He always advises people on a path. He's just not like, you know what, I cannot qualify you and goodbye. Like he says, hey, you know what, this is a plan of action. I'll see you in the next couple of months. And then then we can come back and revisit. But people, they have to do the work, right? I mean, it
It's a
doesn't matter.
process.
It is a process.
And sometimes people that want to come in and get qualified to buy their home, it may not be right when you sit down for the first time.
Yeah.
So like I say, there is a process that we go through and make a plan of what you need to do. And it may be reducing your debt. It may be saving more for the down payment.
Yeah.
And make the plan. Or if you're self-employed, it may just be waiting, another year to have the proof of the self-employment that you're doing so that we can qualify you.
Yeah. Yeah, I think
but the worst thing you can do if you are thinking about buying a house is not talk to a lender about it, not come and talk to me about it, because I know it's challenging. You don't know, but it is something that you can achieve. Mm-hmm. But if you never do it, you'll never know.
Exactly.
And some people are surprised, and there are programs you don't need 100%. You don't need a down payment. There are programs that will allow you to qualify without a down payment. You don't need perfect credit.
Yeah.
But if you don't know what you qualify for, it makes it a little bit harder. And I don't think Maly wants to be a travel guide and take everybody around and have them ride in your car, and then you come in and they can't qualify.
And that's what I tell people, and that's what I tell my clients. We need to know, like, what if we go to this beautiful home and you want to write an offer and we can't, right? So there's like truly no point. They have to be qualified. They need to know where they stand they have to have a better grasp on their finances. And primarily what I hammer on my side, making sure that you can meet your monthly payment, because the least you want to do is getting to a situation where you're really struggling to make the monthly payments, and that's something that I don't, I don't advise or
and that happens a lot where people, just because we can qualify you for a $400,000
or
house
$1 million home,
but that doesn't mean that that's what you want to pay, right?
Exactly.
Whatever you qualify, you want to be comfortable with what you're paying.
Exactly.
And that just depends from situation to situation.
Yeah. Well, thank you. Oh, Chase, Jimmy, he wants to talk to you.
Sure. Love to.
Yeah. He'll connect with you, Chase. Okay, so let's talk about our favorite topic here, lending on Lava Zone 1. Let's talk about it. Lending on Lava Zone 1.
So Lava Zones 1 and 2, for the people that are not familiar with Hawaii, there are lava zones, and basically Lava Zone 2 is any area that's below the volcano rift zone. Yeah. And then so there's a risk of the volcano erupting and then running down that rift zone and covering your property. Lava Zone 2 is less risk.
Less risk, yeah.
And then Lava Zone 1, you're actually in the rift zone. The lava is actually erupting in your subdivision at Leilani Estates in Hilo. That happened. It literally, the eruption happened in that subdivision.
Please don't do it.
So, and there's still, we will lend in Lava Zone 1 on a very, very limited basis. And you have to be able to get insurance, and the insurance is very difficult, and it'll be just case by case. Like you're not going to get lava insurance in Leilani Estates.
What about all the new construction that is popping up in Leilani Estates?
If they're building it without financing, that's their risk that they want to take.
Yeah, that's cash.
It's cash, right? So that's a possibility. But what happened to a lot of people? I'm not saying that'll happen again, but you don't know.
We don't know.
It was a surprise. I'd never, living here all my life and watching the volcano and having it, erupt all where it has. And when that started erupting, even I thought, well, it's just going to erupt a little bit. A little bit.
It took an entire neighborhood.
Yeah, that erupted quite a bit.
It's very scary.
So it is scary, and there is risk. But people like to live on the water.
Yeah.
There's a risk of living on the water.
Yeah.
Lava's a little different. Lava's a little different because lava covers. It's hard to build back over that.
Yeah. Well, I think that, and I said it on a previous interview, I think you have to be at peace with your money, right?
Yeah.
If you are okay with losing it, then.
And there's, Lava Zone 2, and people still think this is going to be on the Hilo side, on the east side.
Yeah.
But Lava Zone 2 will actually start at the City of Refuge Road, Hononau.
Yeah.
And it'll go all the way to past Ocean View. Mm-hmm. And that's going to be all Lava Zone 2. because of lava flow Kona Paradise. That was in 1950,
Wow.
which is not that long ago for lava, so those would be, all those areas are still lava zone 2. And that's from Mauna Loa.
Mauna Loa. Well, yeah, I mean, if you are really adamant on getting a loan for lava zone 1, contact Jimmy.
No.
No, but like you said, it's very difficult to make things happen down there, and I personally would not advise anybody to get into lava zone 1. But like I said, if you are at peace with your money and you want to pay it cash, or you're really wanting to get creative and need assistance, perhaps Jimmy has somebody that can assist. But it's very, very, very challenging and very difficult.
And so what happens, right? Because of the lava zones, obviously the property is going to be less expensive.
Yeah.
So it'll be more affordable for people.
Yeah. It's just one of those things, right? It's like, it's affordable, but it's in lava zone 1, right? So, and there's new construction happening in Leilani, right? I mean, the houses are gorgeous.
Yeah.
They're really beautiful, but they're in danger zone. So just be careful. How much money do I need for a down payment? This is another question that we get very often.
So again, there are 100% financing programs.
Yeah.
Through USDA, VA, which you have to be a veteran. So conventional loans, you can do with as little as 3%. FHA is 3.5%. Anything less than 20% requires mortgage insurance. But there are loans that are available with less money down. So you don't need the traditional 20% that everybody says that you have to have when you go out, or the myth is that you have to have a 20% down payment to buy a house, and that's just not true.
Okay, well said. Will my down payment vary based on the loan that I chose?
Yes, whether you're conventional or USDA or VA.
So it's not as strict.
It's not. Well, there's just like different products have different
products. Okay, different interest rates.
But for majority of people, there are quite a few veterans, and you have the benefit of 100% financing.
Yeah.
And but the USDA loans are a little bit more limited and geographically. Also, there's income restrictions on USDA. And then the conventional loans with 3 and 5% down are pretty often that we're doing 5%. 5% down is probably the most probably prevalent of the down payments that I work with. 3%, you can do 3% down, but then your credit has to be better because you're putting less money down.
Yeah. Okay. So we're going to move on to another question here. What is the interest rate and the annual percentage APR?
Okay. This is a little harder to explain, but the interest rate...
Go for it.
The interest rate is the rate that you will make your mortgage payment on. So if your rate's at 3%, the payment will be calculated at that 3% interest rate. The APR factors in the cost of the loan over the life of the loan. So if you're paying mortgage insurance, that's going to be a cost over the life of the loan. If you pay points to buy your rate lower, that's a cost of the loan. And all those costs are calculated over the life of the loan, and that will be the annual percentage rate.
Awesome. So
it's a true cost of the money. And when you shop for loans, that's really the best rate to compare, because the annual percentage rate should be the rate that's going to show you what the total cost of. So a 3% rate may sound really good, but if your APR is 3.5, that means that you're paying points, and it may not be the best rate.
Gotcha. So what is the difference between locking a rate or floating a rate?
Well, you have the ability, once you enter into a contract, you have the ability to lock the rate. And you can lock it for various time periods, 30, 45, 60 days. But you have to close on the loan within those lock periods.
Yeah.
And what locking the rate does, it protects you. If the rates go up, you're locked in and your rate won't change. If you float the rate, and the other thing, when you lock the rate, it's protected from going up, but you can't float it to go lower if rates go lower. You don't get the best of both worlds, right? So if you're floating the rate, it goes up or down, you have that risk. So if you are comfortable watching the stock market go up and down, and you don't care watching your money lose or gain. So that's a kind of a judgment of how I ask people how comfortable they are. If it makes you nervous, lock the rate.
Just lock it.
Yeah. And right now, where interest rates, everybody, and it's out there that rates are at their all-time lows.
Right.
But the last couple of weeks, rates have taken a turn for
Gone up.
they're going up, and they've probably gone up about 0.5% in the last 3 to 4 weeks. And there's a lot of volatility in the market, and I think that there's more risk for rates to go up. So if you do find something, you might want to lock it in.
Just lock it in already. Yep. And the fact that we're struggling with inventory as well, it's not a good combo.
And you're talking about rates were at 2 3/4, and now they're at 3 1/4. I mean, those are still rates that are all-time lows.
Right.
So
yeah, exactly.
It's still a good environment.
Compared, exactly. You're right. But we all want the deal, right? We all want like the really nice rate. But yeah, to your point, they're going up. And okay, so what will my closing costs be? Are they part of my loan, or will I pay them in cash at closing?
So your closing costs are in addition to your down payment. And the way to look at it, the loans that cost more, they cost more because you're using some of the money to buy the interest rate lower. And they're called points. So if you have a rate at 3 1/4 without any points, a point is 1% of your loan amount. Mm-hmm. So if you wanted to buy that rate down from 3 1/4 to 3, it may cost you a point, and that point you would pay for at closing. Okay. So on a $300,000 loan, if you paid a point, it would be $3,000. And so you'd have to have that in addition to your down payment. And there's other fees involved in the real estate transaction: appraisal fees, escrow, title, recording fees, home inspections, termite inspections. So there's a variety of different fees. General rule, 2-3% of your purchase price in closing costs.
Yeah, that's a great rule of thumb, because we do get asked that very often. How can I get some?
And just on the closing costs? So the seller can actually pay the closing costs.
Yeah.
It's a little harder in this market.
Yeah.
But if you're limited on your down payment, say you only have 5%, so you can ask for closing costs. And a lot of times what we'll do is if the property is listed for sale for $350 and you need money for your closing costs, you offer $355 and they give you $5,000 in credit and you use that towards your closing costs.
Golden nugget there.
It's harder in this market.
It is very harder.
And that's another thing that when you're out there, when you're looking, it's a must to get pre-approved.
Yeah.
Because nobody's going to take an offer that you don't have a pre-approval with.
Nope.
And I know that agents have said this over years and years and years. No, there's offers coming in. You got to make your offer. And maybe that wasn't as true, but now
it is true.
It is true. There are multiple offers on properties all the time because there's just not enough inventory.
Yeah.
Probably partly due to lower interest rates, partly that people want to move to Hawaii, and it's a good place to live.
Jeez.
So
that is so true. Like offers are flying in.
Yep. It's hard. It's harder when you're buying. So like when Maly tells you got to make an offer on something, even if she's telling you people are buying the properties without even looking at them.
Yeah, there's a lot of sight unseen now.
And you always can build in your contingencies for your inspections that will allow you to get out of the contract. But that's happening more and more where people are just writing offers without seeing them.
And and for folks that they're in their 50s, 60s, they cannot believe that people are buying sight unseen. Like they cannot, like clients that they're like, oh my goodness. They're like, is this really happening? Is this a market that we're living in? And that's the reality.
Or they'll be, I never pay full price. Right? Never pay full price.
Never pay full price.
And that's, and everybody thinks that there's always, it just depends on the market. And right now it's a seller's market.
It is a seller's market.
If it's nice and it's good and it's priced right, there'll be multiple offers and it'll probably end up selling for more.
For more, yeah. Yeah, and especially in subdivisions where inventory doesn't open quite often, those are the ones that are harder to get in.
But it is worth it.
It is totally
it is worth it. So it's a really good goal to have, and would really like to help you achieve that goal.
Yes. Yeah, I mean, just living here in paradise. Look at our tans.
Not me,
we're
but
so
you.
tan. No, but it's really nice to live here in Hawaii. What is like the favorite thing that you like to do when you're off work?
Go to the beach.
Yeah. Which one?
I like to go to Magic's.
Yes.
But
Well, right now there's no sand.
Oh, there is sand. Sand came back.
Well, a little bit. Oh, it came back a little bit. Yeah. Oh, I was thinking.
The reason why
Kua.
they call it magic is because when there's
because
waves, the
it
sand goes
disappears.
out.
Yeah, you're right.
Called
I haven't
disappearing
been to the
sands.
beach in a while, but Kua. I was thinking about Kua Bay. So let's move on to another question. How can I get okay? So what is the difference between pre-approval and pre-qualification?
Okay. So a pre-qualification is basically you tell me what your income is, you tell me what your savings are, and I'll do a calculation and come up with a number and say you're pre-qualified. Mm-hmm. Haven't verified it, haven't pulled credit, haven't run the numbers through the automated underwriting system. That's kind of a pre-qualification. Mm-hmm. Pretty easy to do. You don't have to do a lot.
Yeah.
Doesn't have much meaning though. Mm. Whereas a pre-approval, we're doing a complete application, running, pulling your credit, running it through an automated underwriting system. Sometimes we'll verify income and assets during the pre-approval process, but we don't have to do that. And if we're verifying it, we just go off of what you say, and we'll use that pre-approval. And a lot easier if you're employed or you're getting a W-2 and a pay stub. It's pretty easy to determine what you qualify just based on you tell me what you earn. Self-employed is a little bit different because being self-employed, a lot of people tell you, well, I make $100,000 a year. And I'll look at the tax return, and that was their gross. They had gross sales of $100,000. By the time they deduct all their expenses, they only made $20,000.
Yeah.
And so it's a little bit harder to do pre-approvals. Not harder, but a little more. It takes a little bit more to do a pre-approval for somebody that's self-employed. Because I don't want to issue a pre-approval to somebody, and then you go out and you find something, and then go, oh, you don't qualify.
Yeah.
And so if you're self-employed, I would ask for 2 years tax returns to determine what your income would be that we could use.
Beautiful. Yes. Yeah. And you know what? And for people that are going through the pre-approval process, having an expert on the field truly pays off. You can go to a bank on the mainland, and they might send you through a whole call center of people, and you don't have specific person to look over your file and go over all these things with you. So I think that's where it kind of pays off to have somebody by your side. And it doesn't I would love for you guys to utilize Jimmy, but if you have somebody that you trust, kind of like Jimmy, will make things easier on the lending side. And also, because we are in an aggressive market, I am able to, if I need to, knock on your door and be like, Jimmy, what's up with this file or this pre-approval letter, to where if you're dealing with somebody on the mainland, it's harder
to get in touch.
And so those are also the benefits of working with somebody locally. We have a question from somebody in the group, Judy. She's asking, what is the difference between a second home and a second home and an investment property?
Okay, a second home is a property that you would purchase to use as a secondary residence. You have a primary residence. You can't have a secondary residence next to your primary. Mm-hmm. The rate's the same for a secondary versus a primary. And the secondary residence you can use, and you could actually rent the secondary residence out, but you have to occupy that for that secondary home, the second home, for at least 2 weeks out of the year. Mm. And you can't sign long-term leases. And then you'll be able to qualify for second home down payments. Minimum down payment on a second home would be 10%. Mm-hmm. And then the rate is the same as a primary. So a lot of people, like Hawaii, obviously, people live in the mainland, they come to Hawaii and they buy a second home. So when they come here, they can stay in the house, and then they rent it out when they're not here. Yeah. So Hawaii is really a perfect place for a secondary residence. Perfect. When you buy the secondary residence, you can't use any of the income. So if you are renting it out, or your plan is to rent it out for part-time, you can't use any of that income to qualify. You have to qualify for the payment without any rental income. Oh, very interesting. Yeah. So, and then an investment property, you need you can do it with 15% down, but it's the loan's expensive. The rate's going to be a lot higher with 15% down. Mm-hmm. Typically, if you're doing an investment property, you want to have a 25% down payment. Yeah. And you're able to, if you have a history of renting property, you can use that rental income. You can use that rental income as income to offset the payment as well.
Yeah.
If you're buying a new investment property, if you have a primary residence and you want to go and buy an investment property and you don't have rental experience or management experience of renting a house, you would have to qualify for the loan with that payment. You could use the rent to offset the payment, but you wouldn't be able to use any of that income. So, and obviously on an investment, the rate's going to be higher because all the loans are based off of risk, right? Perceived risk. So if you look at a primary residence, it's going to be generally less risky because that's your primary. A secondary residence, if things aren't getting trouble, easier to let go of the secondary residence, hang on to your primary. And then obviously the investment property is going to even be, the perceived risk is going to be even more because if you do get in trouble, you got a second home, you got a primary, you have an investment property, you're most likely going to let the investment property go. In theory, it's not always like that, but that's why they have the differences in rates, and not so much on the second home where it's not the rate, but it is down payment, and the investment's going to be down payment and rate.
That's great advice, and that's I get asked that question very often as well. You know, people that are they're looking at Hawaii to make an investment. They're looking for an STVR ready property, and so that's something that Jimmy specializes on a lot. So here's another question. What is the biggest hurdle that you encounter as a lender when dealing with people who are wanting to buy?
Probably their fear to apply. And it can be intimidating.
So true.
You know, it can be intimidating.
Yeah.
But that, and then people are not prepared. You know, and they don't have things together.
Yeah.
And they haven't even really planned. And so when you're looking to apply, you want to be able to know what your income is. You want to have your documentation together.
Yeah.
Your pay stubs and your W-2s, all information that you can get offline or get online. And having that all together makes it a lot easier. But people that don't plan and they just want to come in and be pre-approved and have no idea what they make or what they have saved or what their goal is, that makes it a little bit harder. Yeah.
You know what? I think in going back on the fear of applying, we see it very, very, very often where, you know, we have conversations with clients that are really wanting to make this island their home. And for some reason, the fear of applying, right? And so...
And the process is, or for me as a loan officer, and I sit down and I interview somebody, if you don't qualify...
He'll tell you.
No, I'll tell you, but I'm also going to tell you in a way that doesn't embarrass you, doesn't make you feel bad, because not everybody is going to qualify for a house. Not everybody will be able to buy a house. But if we set a plan and you follow those steps, it can be achievable, and it is for a lot of people.
Exactly. And I think that him going through your finances and have a better understanding of what you can afford will just basically jumpstart you to heavily look into like either you can make the move or not, right? You will help people.
It'll help you know what
and
you
know
can
what?
do.
And what I like about you is that you don't pressure people into like apply, like you are willing to get in a conversation with them and kind of run through their finances and you know, assess whether if it's worth applying or not.
If you're not ready for whatever reason.
And if you're not ready for whatever reason also, because there's time frames on the application, right?
Well, but it's also that, you know, it doesn't make a whole lot of sense to rush into an application if your credit needs work or you don't have the down payment saved or you started a new job or you're just recently self-employed. Or you're self-employed and you're not reporting all of your income.
Those are harder.
Then you're not going to qualify, you know. So.
Well, if you are taking anything away from this conversation, anything at all, if you're self-employed, try to report all of your income. That helps you like tremendously.
And I get it. It's a catch-22.
Oh yeah.
Because you report all your income. Now the IRS wants their share.
Yeah.
But you know what's going to be more to, and you know everybody needs to pay taxes. I'm sorry.
Yeah.
I pay taxes, so
we all pay taxes.
We all pay taxes. That's part of it, and it's one of the things that we're going to look at. You know, if you're getting a paycheck, you know the taxes are taken out.
Yeah.
If you're self-employed, you know, and you can claim whatever you want to claim.
Yeah.
And then when it comes to qualify, it's not going to work. And then when you're using self-employed income, you have to do an average, and we'll do a 24-month average.
Yeah.
So if you have one good year and the next year is bad, that's not good.
Right.
So they'll take the lower of the 2 years. If you have a good year and a better year, they'll average. So they do the more conservative look at it. They won't look at, 2019 you made 80,000, 2020 you made 60. They're not going to do that average. They're going to use the lower of the two.
Mm.
Reverse, they would do the average. If you made 80 and then you made 100, they would do a 24-month average, right? So not use the 100. Yeah. Doesn't seem fair.
Doesn't seem fair at all. Jeez, that's the cost of being self-employed. Yes.
But you can be your own boss.
You can be, hey, you're boss lady or boss guy, but no bus guy? No.
No bus guy.
No. He knows pigeon though. Can you break a little pigeon?
No. My dad was an English teacher, so I don't.
He's very proper. He knows pigeon. I don't know if any of you watching, we have a couple of people here, but if any of you know what pigeon is, Jimmy could break pigeon.
No.
But no, he won't do it because we're professionals.
Because I'm at the tiki bar, but I haven't had a drink, so I'm not going to do pigeon. If I was drinking, maybe I'd do pigeon.
Yeah. All right. So, how about this one? Tatiana is asking. We already talked about the credit score requirements, so we don't need to go over that as well. But she said, I recently changed jobs, but I'm in the same line of work. Is that okay?
Yeah, that's fine. Typically if you're changing jobs for reasons, most of the time you're changing for a better pay or more income.
Yeah.
And if you're in the same line of work, it doesn't affect anything. If you go out of the workforce and you come back, it's usually 6 months when you return back to work before we'd be able to give you a loan. Mm. But changing jobs, it doesn't affect anything. Okay. Now, if you get a job that's lower, it's going to, then you're going to qualify for less. Mm-hmm. But if you're in the same field, it's not like you would have to wait 6 months. Mm-hmm. But if you go into a brand new field and you don't have a history of being in that field, then there's a waiting period to show that you're able to make that money.
Okay, so that answers that, Tatiana. Now we're coming almost to the end of our conversation. Thank you for the people that are watching, for the people that are here. Final thoughts on the lending environment. What do you think interest rates will do in the future?
Break
your magic ball,
break
Jimmy.
My magic, yeah. Nobody knows, honestly.
It's hard,
nobody knows what rates are going to do, but everybody has their ideas, and you can read and you can study. You can look at Wall Street and see what they're saying, and we do. And the rates are based off of two things. It's the 10-year Treasury and mortgage-backed securities. And recently, there's been a lot of volatility. I've been doing, like I said, 30 years, and we've had days, and I haven't seen these in a long time, where the rates will change 3 times during the day to higher prices. And then at the end of the day, they'll change and they'll improve 2 times. And it's just the market that's kind of nervous about the 1.9 trillion, about the money that the government's spending. And there's fears for inflation, and that causes the rates to move up. We have, gas has gone up $1. Oil's getting the all-time highs, or not all-time highs, but are starting to hit yearly highs, like $65 hasn't been. And all those things factor into what interest rates are going to be. And so the thought is that rates are going to stay relatively low, but they are going to go up. But again, we're going up from 2 5/8 to 3 5/8, or even if they're 4-5%, those are still really good rates. But now we're at some of the all-time lows. The rates are as high as they've been since, I think it was June of last year, that they've gone up this last couple of weeks. And when the rates start going up, they have a tendency to go up a lot quicker. So, once it starts moving, there's fear, and nobody wants to be stuck buying a mortgage-backed security at a coupon of 1.5% to 2% when they can get 2.5% to 3%. And you're going to have to hang on to that for 30 years. It's not a good thing. So when they start going up, everybody wants to try to sell the mortgage-backed securities, and it causes rates to go up. And but nobody knows. Nobody knows.
Yeah, it is very difficult to predict.
So the best way, if you're in it, like we talked about a little bit earlier,
Yeah.
if you're nervous about the market,
Yeah.
then lock your interest rate because that protects you. And I've seen this where people don't lock and it starts going up and up and
Right.
up. And you can get to the point where rates increase to where you won't qualify. So if you're barely qualifying on the rate that you're started with, you might want to lock because if it starts going up, then you don't qualify, and that's kind of a bummer.
Yeah, you don't want to be there. Yeah, you don't want to be in that position.
Yeah.
Well, guys, thank you so much for being here and for tuning in. And if any of you have any questions, feel free to email us. Jimmy, what's your email address?
My email address is really easy. It's
Very.
Jim, Jim.m.allen, ALLEN, @rate.com.
Yes. Super easy.
You proud that I remember that? No.
Yes.
I know my own email address. Awesome.
Yeah.
No,
And-
but do email me or
Yes.
call me. My number is 808-938-3913.
It's a local number.
The local number. And the one thing I do, and I strive to do this, I will answer your phone call.
He does.
And I'm in this business, you have to work all days.
Yes. Same.
Even on vacation, working.
Even on vacation. And he's always available. He's always a phone call away, a text away, an email away. And there hasn't been a time where I cannot get a hold of you. So thank you for that.
You're welcome.
Well, if you guys have any other questions for me or Jimmy, feel free to post them in the comments. But if not, we'll just say aloha.
Happy Aloha Friday.
Happy Aloha Friday, guys. Bye.
Bye.